Hi, this is Todd of Kendall Todd and the BarSmart RepaySmart software. We're going to be looking at a case study, and this particular case study is coming in from a loan officer up in Minnesota. I've changed the client's name, but they're in Eden Prairie, Minnesota. And in this particular situation, the loan officer was just wanting a little bit of help thinking about how to present a particular case. And this particular client, I'm going to follow up with an interview we just did with Jack Kinsey talking about debt repayment, debt snowballing, and just the real power of being able to help people with both an entrance strategy when they borrow and an exit strategy for how they're going to pay off their debt. So let's look at the situation here for a second, and let's just kind of start right at the beginning with their current situation. They have a house worth $265,000. They have gross income of $90,000, and they're in a 31% state and federal tax bracket. Now here's their current borrowing situation. They have current liabilities. They have a mortgage with a 30-year fixed, Bank of America at 6.25. The balance is $156,500, and they're currently paying $983.21 per month. Now I'm going to leave this blank for now just to simplify. So we'll take sort of a tip from Adam Snively in his interview, which is just keep it as simple as you possibly can. In this case, for this example, we'll just leave the tax insurance MI off since it's a refinance, and they'll be the same either way. They have a Ford Motor Credit Auto at 6.5. They owe $23,450 and $388 a month is their payment. And they have 3 credit cards: a Discover, a JCPenney, and a MasterCard. Different interest rates, different balances, and they're paying more than the minimum. They're paying $100 a month on one, $100 a month on the other, and $150 on this one. Now let's talk about why they called this particular loan officer. They wanted to get out of debt as quickly as possible. They went to a Dave Ramsey program at their church, and they thought it was really interesting, and a lot of it was about debt management and the concept of snowballing. Okay, again, the concept of snowballing has been around for a long time. It's one of many, many different ways to accelerate or prepay your debt and your liabilities, but it's one that we've built in to the software as part of the repayment strategy. So let's just kind of take this case and walk it through. So this is the current situation. So when I click on the next tab, Suitability, you'll notice that one of the questions was, do you have any additional monies that you would apply from savings or investments towards this refinance? And this client said that they had about $15,000. This was money that they just kind of had not really earmarked for anything. It was in a money market type account, and they were just looking for, just some cash that they had. They could put it in an investment account, or they could use it to prepay their debt. Now, whether that's the best thing for them or not, I mean, that's part of your conversation, but this is what they want to look at applying towards their debt. So this is what we're going to model for them. They think they'll be in this house for 21 to 30 years, so they're not planning to move. They'd like to pay the house off in 11 to 15 years. That's the goal they set when they went through their course. They have over $126,000 or more in other assets. They have no major purchases, and they would like to roll in their closing costs. So clearly for them, they're interested in a higher payment, paying principal each month, and they consider themselves moderate. They weren't necessarily aggressive or conservative in their borrowing. So when we go to the Analyze tab, think of Analyze as your borrowing strategy. How are you going to think about borrowing in this particular situation? Now, the first thing we see, I'm going to kind of refresh what you're looking at here. When you look at the current liabilities, you're seeing that they have a total of $193,650 in debt. That's a summary of all their debt. They have a variety of pre-tax rates from 6.25 at the low end to 14.99, but their weighted pre-tax cost of borrowing is 6.771. So that's their pre-tax cost of all of this debt weighted: 6.25 based on 156, 6.5 based on 23, 11.9 based on 3.8. I think of this as the friction point. It's the amount of friction they have. It's what's working against them and compounding against them on a daily basis, on a pre-tax basis. Then we have EPR. Remember, that's one of our concepts in the book called effective percentage rate. It's just the after-tax cost of borrowing expressed as a percent. So it's easier for the client to understand. 6.25 and it's tax deductible doesn't help the client understand their situation. But 4.312, that means based on their current tax bracket and the interest, that's about the approximate rate that they're paying on their debt on an after-tax basis. The auto at 6.5 is still 6.5, as well as the credit card. 12.99 is still 12.99. Why is that? Because those interest rates are not tax deductible. So we can see the EPR, the after-tax cost of those debts, and the weighted after-tax cost of borrowing is 5.205. So if I was sitting here with a client, and Jack mentioned that this is something he's comfortable now doing live with his clients, and you can be too, you can come across here and say, look, here's your current borrowing, $193,650. On a pre-tax basis, you're paying about 6.7% for all that debt. On an after-tax basis, what your true cost is really around 5.25%. You're actually paying $1,721 a month. That's before taxes, and you've got a tax offset here of about $253. Now look at the payments, because we're already getting into some of the value here of helping them to think through their payment structure. Their current mortgage with Bank of America has 340 payments to go at $983 a month. They have 74 payments on their auto, 49 on their Discover, 42 on their JCPenney, and 62 on their MasterCard. Now where does this number 180? And I thought one of the things that was interesting about this case is this client currently is 180 months away from being debt-free. Now, how is that possible? Because it says here they have 340 payments on their mortgage. Well, that's 340 payments at $983 a month. The concept of snowballing is actually already built into some of these numbers, because if we take that payment of $1,721 a month that they're making now, I can see that the shortest term liability they have is this JCPenney card. They have 42 months to go. So at the end of 42 months, they will have that card paid off, and this $100 a month becomes discretionary. They can spend it, they can save it, or they can use it to prepay other debt. So what if in that month, on the 43rd month, they took $100 that has now been freed up and they applied it towards the Discover card? If they did that, that debt would be paid off much faster. And in 49 months, both of these debts are going to be paid off. That gives them $200 a month in discretionary cash flow that they could apply towards this debt. Now that debt's going to pay off much faster. And when that debt's paid off, they'll have $350 a month that could be applied towards their auto. Once the auto's paid off, they'd have this $350 plus this $388, allowing them to pay off the remaining debt in 180 months. So this is looking at all of their current borrowing and this current commitment. They've already committed to spend $1,721 a month, right? That's what they're paying now. So what's neat about this is you're saying you know you can do this because you're doing it today. And if you just continue to do that on a look-forward basis, you could be debt-free in 180 months. Now, the client wanted to refinance to a 15-year fixed and consolidate all of their current borrowing and then figure out what's the fastest way for them to get out of debt. So they wanted to kind of compare, should we just snowball our current debt and see how fast we can pay that off? And look, I can already tell them without doing anything but just putting in their information, they could prepay and repay all of their current debt in 180 months. But they were interested in a 15-year fixed. Well, if they could be debt-free in 180 months just by snowballing their current debt, why would they do a 15-year fixed with this loan officer? And this was part of the challenge for the loan officer. It was, how do I explain this in a way that helps the client to move forward with a refinance? So when we look at their current situation, you'll notice I'm only providing one option here, the 15-year fixed, and I've got a 74% LTV, 96,100 loan amount. Why would I do that? Because I want to make sure we roll the closing costs in so they don't have any out-of-pocket expense if possible. And we're quoting a 4.5% rate here. So I can already see that all of my borrowing now is at 4.5 versus 6.77. So intuitively, I should know what? If I was going to make $1,721 a month as a payment at 6.77 pre-tax or 5.25 after-tax, I should be able to pay it off even faster at 4.5 pre-tax or 3.1 after-tax. So that just intuitively tells me that there's a benefit here in them doing this. I can see my new payment is $1,500 on the dot. Interesting how these things worked out. And the payments here, $180 because it's a 15-year fixed. So it looks the same, right, at first, because even if I take this current liability to a new 15-year fixed, it looks like I'm going to be debt-free in 180 months. But I'm debt-free in 180 months with only a $1,500 a month payment. Here, I have a $1,721 payment. So I can see that I can get to this point, debt-free in 180 months at $1,500 a month versus debt-free in 180 months at $1,721 a month. So again, I haven't even had to go into the analysis to be able to explain to the client what? That this makes sense. I can give you an extra $221 a month and still have you debt-free in 180 months. But they want to know how quickly can they get paid off. So let's go through and then break that down and look at the example here. On the 15-year fix, they're going to have about $2,500 in closing costs. So they're going to have that coming out of pocket. Now, they said they had $15,000 in cash available. So because they gave us that 15 number to work with, if they don't do anything currently, they can just take that 15,000 and apply it towards their debt. In this situation, they've got $2,500 in closing costs, so that's coming out of pocket. But we're giving them $2,450 cash at closing. Where's that coming from? Because I bumped the loan amount right here. Now I could go through and say, let's don't do that. Let's take this and make this $193,650. And watch, I mean, just one tab, everything's been recalculated. And now I can see they're going to have to come out of pocket for $2,500 at closing. The cash that they have now is $15,000. So if they do the transaction and keep their loan amount exactly the same, just consolidating it into one new loan, they're out of pocket $2,500. So don't do anything. I have $15,000. Do the transaction. I have $12,500. So I have less cash here than I have here. But then I can look at the cash flow impact. Here I'm borrowing on an after-tax basis at 5.205. If I want to show pre-tax, I simply shrink that up. And I'm saying, hey, you're paying 6.771 pre-tax versus 4.5. That's still a decrease of 2.271%. And I can see here my net payment is $1,721 versus $1,481. So now you'll see there's $240 a month in positive cash flow. Originally I said there was about $221 a month because it was $1,500, but now the payments dropped to $1,481 because I reduced the loan amount. But see, I changed that one variable, and every single thing that I need to look at has been changed for me. All the math has now been equalized based on that change. I have $12,500 in cash and $240 a month in cash flow, or $15,000 in cash and no change in monthly cash flow. What does that tell me? Now again, I would normally show on an after-tax basis because I'm going to lose a little bit of my tax benefits here by prepaying this debt faster and by going to a much lower interest rate. But I'm just going to leave it now pre-tax just for simplicity because I'm just wanting you to understand the concept of how you might communicate the value of your advice to a client. Their target time frame is 15 years. So I'm going to snap this to 15 years. And guess what? I'm not even going to have to show the equity comparison or the payment comparison because we know in 15 years they're debt-free. So why get into that? Let's go right down and just expand the prepayment comparison over 15 years. So if I look at this 6.771%, this new cost of borrowing, this $15,000 cash I have, and this current house value of $265, in 15 years my mortgage balance is zero, my other liabilities are zero, and I could actually have $51,938 in savings over that time period because I'm going to actually be able to pay the house off even faster if I snowball. See, this is actually calculating the pre-tax savings here is going to take this client situation and see how fast could they be paid off. They could be paid off in 150 months in their current situation. All right, that's because they have that ability to prepay. And this is saying, now up here, remember, when you look at this is just saying their current situation. If they just paid $1,721 a month, they could be debt-free in 180 months. But down here, it's saying that you've got $15,000 cash at closing, and we're looking at a prepay scenario. So we're going to open up here at closing. If we don't do anything, if we just keep the current mortgage, you're going to pay that $15,000 down, and you're going to accelerate your debt as quickly as you could. You could be debt-free in 150 months in that scenario. But go with my new scenario here at 4.5, and I have $12,500 at closing I could apply towards my debt. Now, I'm actually going to be debt-free in what looks like about 14 years. So I can go through and kind of shrink this down a little bit, take it down to 12 years. 14 years if I want to. Go ahead and make this even more exciting to show the client. We're looking at just a 13-year time frame here, and I can see the equity that I'll have in both of these scenarios. But look at the difference. At the end of 13 years, I have no net savings in this current scenario, but I am debt-free in 150 months, and my mortgage is paid off. Drop it back one more year, 12 years. I still owe $9,849 here, nothing here. This is another way to kind of back in to the exciting aspect of this for the client. Let's just go to 11 years. Now, their goal was to be debt-free in 15 years. I'm saying let's take an 11-year time frame. If you keep what you have today, okay, you could be close to debt-free. You wouldn't be debt-free in 11 years. You'd still owe $29,226. In 12 years, you'd have $9,849. But look, in my new scenario, you're already debt-free at this point, because I can have you debt-free in 135 months, saving you $26,866. So is there any reason for this client not to do this scenario? Because I'm still going to put them out of debt in as quick a manner as possible, but I'm showing them how they could be debt-free in 135 months versus 150 in a best-case scenario. So again, just ways to think about this. You can do it a number of different ways. Adam mentioned in our video with him, he likes to go out and just take it out 1 year and just kind of look at the 1 year and the equity in 1 year. 96,067, 96,614. After 1 year, the savings of 547. So I already know after 1 year this is good. If this is good after 1 year, then what's it going to look like in 10, 12, 13, 14, 15 years? In 15 years, I'm debt-free, but I'm positive $27,042. And I've saved an average of $150 a month over keeping my current situation. Now, I could do all this with just this one page, but one of the things that we've built into this is the ability to model these different scenarios visually for the client, which is one of the things that Jack said that he was having a lot of success with, is showing clients how this works. Now, I can go all the way out to 30 years, right, and show the impact of this over 30 years. You're going to be debt-free in 27 years, 1 month. That's all you have left. But we're looking at a 15-year time frame. So what I like to do is just take it to their time frame, go out 15 years, and say, look at your current situation. You're debt-free in 27 years, 1 month, but at the end of 15 years, I can see where you are here. I can put my mouse over it. You still owe $106,556, and you're going to spend $290,756 over that time period if you keep your normal scenario. All right. If I look at this over just comparing, again, not snowballing, just normal payment to payment, and you go and I refinance you to a new mortgage at this lower interest rate after tax, and this $193,650, and you got $12,500 available cash, you got $212 a month after tax to cash flow to deal with, then I could actually have you debt free in 20 years, 8 months. So what are we doing? Just on a normal payment, no debt snowball, nothing fancy, just on a normal scenario. I'm looking at how would you look in 15 years staying with what you got today? Gosh, you'd still owe $106,556. How would you look in 15 years with my scenario? Gosh, you're actually debt free right here. You're debt free a year earlier. Again, that's very, very simple for the client to see and very, very compelling. Now, what about on a debt snowball? I simply click this and say debt snowball, and let's go with lowest balance first. And this is interesting because if I keep my current mortgage and debt snowball, I could be debt free in 13 years, 8 months in this situation. That's pretty exciting. That means I don't have to do anything but snowball. But if I go with your recommendation, I would be debt free in 12 years, 11 months with the snowballing. I'm saving $32,000 over that time period. So again, it's very easy to say, is this worth $32,000 to you to be debt free in 12 years, 11 months if we set it up in this particular scenario? And actually, it's faster than that, because actually this is set to spend right now, and we know that the client's willing to prepay that. So I want to go ahead and slide this over. This is the $12,500 they have left over at closing. Up here, that $15,000 they have would just go right to prepay that current debt, right? So down here, that $12,500 would go to prepay. But what's different? I have $212 a month on an after-tax basis to prepay. So now let's look at it. I can see that I'm going to be in 12 years, 6 months debt-free versus 11 years, 11 months, still a savings of $18,000. And to do a really amazing report for the client, I just simply click on the report tab. I'd select everything here, and then I would go through and click debt snowball strategy and then create your report. Now, one of the things that that Jack showed in his thing, and this is another reason I wanted to point this particular case out, is you may have situations where a client can't qualify. Let's just say that their house right now in this situation was worth $200,000. Oops, not $20,000, $200,000. Okay, we now know that with a $200,000 house, that same LTV, that's not going to work. I need $193,650 for this to work, and my LTV is going to be 96%. That doesn't work. But I still want to be able to help this client. How could you make money helping a client that you can't do a loan for? Well, you simply shrink up this example here, And what we now assume is that there is no current new debt structure for this client. All we want to then do is look at their current liabilities. And when I come to the repay tab now, what it's done is this is all shifted. This is their current scenario, 28 years, 4 months to be debt-free. This is what they're going to spend. Now I can help them model a new strategy such as snowball, highest interest rate first. Okay, we're going to use after-tax basis and a time frame of 15 years. And if I just had you create a snowball plan for this client, I could have them debt-free in 13 years, 8 months, which would save them $22,601. And notice what I'm doing now is there is no mortgage today for me to help this client with. What I'm going to do is simply create a totally new plan for them, showing them the situation I could put them in over time. Let's go ahead and just take this out maybe 30 years, or let's take it out 28 years. Keep your current scenario, and you'll notice in 4 years, 4 months, you're just paying things off. You're going to spend $325,000. Go with my program. We'll create a debt snowball program for you. It's only $297 for me to create this report for you and show you how to do it. I can have you debt free in 13 years, 8 months. And what happens when you're debt free? When you're debt free, this $1468 a month payment that you had is gone. You can begin to save that. And we're assuming your savings rate is 0. This is just your principal accumulation. So here, I'm still paying to right here to be debt free. Here, I'm debt free here, and that money gets to go into my savings. So look at my situation. In this scenario, I still owe $3,881 at the end of 28 years. That's my time frame. Here, I'm debt free, and in 20 years, I have $295,772. Which situation would you rather be in? And again, this is where, if you start thinking about the value of your advice, you can start to model a variety of different scenarios for your client, create a report for them. And when I go to the report page now, it's very different because all of the information that's relevant to the client is available here. There's not nearly as much stuff because we're just doing a comprehensive debt snowball report, and maybe you want to go through and show the cash flow and current liabilities. But now I can generate a 10 to 12 page debt snowball plan for this client and create some nice fee income. So I'd really encourage you from a case study standpoint, if you haven't thought about that, every client you have is a prospect now to be worked with. If you cannot help them here on the Analyze tab because you cannot find them new borrowing that's going to benefit them and you're a loan officer, then all you need to do is shrink these options up and go right to the repay strategy page and start looking at ways to save them money there. This is something that we've gotten a lot of emails from financial advisors who are using this with their clients. They're not licensed to do loans. They don't want to do loans, but they're just sitting down with each client and doing a comprehensive repay analysis to help them save money. If they see that there's an opportunity to refinance as well, they'll have them do that first because it makes a lot of sense in this situation for this client to do both, to refinance to the lower interest rate and then to come over here and use a snowballing strategy to pay off that debt quickly. Now, if this advisor happened to be working with this client and felt that, hey, this client could earn a 6.5% after-tax rate over the next X years, then that same advisor could come in here and say, let's save the $15,000 instead of spending it. So or in this case, $12,500, right? Because that's what they'd have available at closing. Let's save that and let's take the $212 a month and put that into an investment account as well. And look what happens here. The savings passes the debt in 11 years, 2 months. And look at the dramatic impact of the savings, because now as that debt pays off here, this money is starting to compound at 6.5% instead of a principal-only growth, creating a real win-win for the advisor and the loan officer when they collaborate and work together. So take some time and play with this. And again, I just want to really point out that everyone who has debt is a prospect. What you want to start learning to do is monetize the value of your advice. And if you can't do a mortgage for them because there's some situation that's beyond your means, bad credit, poor property value, hey, no problem. Shrink this up, forget about this page, and go right to the repay tab and go through and look at some kind of strategies for your client and be comfortable knowing and simply ask yourself, if I could save this client $300,000 over the next 28 years by working with them and their financial advisor to create a strategy to be debt-free in 12 years, 8 months, and then ultimately to save another 200, well, what was it? In this case, $541,000 because we're compounding at 6.5%. That's pretty darn exciting. Well worth $297 or $497, whatever you believe is fair for your time. So I hope this is helpful. It's a great case study. And again, it gave a lot of opportunities to talk about some of the key features here and ways you can think about really adding value. Think about not only your borrowing strategy at the time of closing, but a good reason to get back with your clients is to sit down and say, let's take some time to go through and analyze some of the repayment options as well. Have a great day, and I wish you all the best.